If you're not using fair value gaps in your trading and you're trading ICT, you are doing it wrong. Fair value gaps are a great way for us to predict where price is about to move to next. We can either use it as a confluence to go with the trend or against the trend. There are two types of fair value gaps I'm going to be covering today. There are normal fair value gaps and there is inverse fair value gaps. We're going to cover both of them, what they mean and why they're so important for you to use in your trading. So first of all, what exactly is a fair value gap? Now a fair value gap is a 3 candlestick pattern. We mark out the top wick of the first candle to the bottom wick of the third candle in a bullish scenario, and that is our fair value gap. So we mark out the center gap here for our fair value gap. Now it's very important to note, if we take the first wick and it overlaps with the third wick, this is not a valid fair value gap. We then cancel out the fair value gap and we keep on looking. Okay, so we must have a gap between the first and the third candle. We must have this. If not, it's not a valid fair value gap. So that's a bullish fair value gap when the price is going up. Now, when the price is moving down in a bearish trend, we take the bottom wick of the first candle to the top wick of the third candle, and that is our bearish fair value gap. Same applies if the candle closes like this and we have an overlap of the candle's wicks, then it's not a valid fair value gap. We must have a gap between the first and the third candle. That is it. Simple as that. Now, what exactly is a fair value gap? A fair value gap is an inefficiency in the market. So as we know, the market likes to rebalance the inefficiencies. So this is why we use them. How exactly do we trade fair value gaps? Now, it's very important to align your time frames using fair value gaps. We wouldn't just like to trade off a 5 minute. We wouldn't just like to trade off a 1 minute fair value gap. It's very important to use both higher time frame and lower time frame fair value gaps in your trading. For example, say this was on the 15-minute time frame. Okay, so this is a 15-minute fair value gap. What we'd like to see on the 15-minute time frame is price retrace back to this level. We want to see some kind of displacement out of the level. This is to make sure we are not reversing. This is to make sure we are just rebalancing. And what we'd like to see is when it displaces back out of the level, we'd like to see a 1 minute fair value gap form as well. Because as we know, as I always go on about, align your time frames. So use the 15-minute and the 1 minute time frame. So when we see a 1 minute fair value gap, we again wait for price to retrace back to this level. We then see some kind of 1 minute break of structure, some 1 minute change in the state of delivery, and that's where we'd enter a trade. So say we entered a trade there, let's do dark green. So say we entered a trade here. We place our stop loss below the fair value gap, because then we've still got breathing room for price to retrace and sweep the liquidity again. But we are covered from breaking through the fair value gap. Now we'd set the take profit at this level here. So this would be on the higher time frame. So this would be a liquidity area. And we've got like a 1 to 3 there. What would price do? Price would react to the 1 minute fair value gap. We'd retrace, we'd go back, we'd retrace, we'd go back, we'd retrace, and then eventually we'd hit take profit. This is obviously the ideal scenario. It doesn't always happen like this, but this is how we trade fair value gaps. We must align our time frames using fair value gaps. Now let's look at the bearish scenario. So the bearish scenario is exactly the same. So price is trading downwards. We all want to see, so again, this is the 15-minute time frame. It's really hard to type on this mouse. Anyway, 15-minute time frame. So what do? We wait for price to retrace back into the area. What we have to see is displacement out of the area. Otherwise, we could just smash straight through the fair value gap. We must see some kind of displacement. Displacement meaning a long wick in the opposite direction. This is displacement. We get a clear reaction out of the level. Again, what do we like to see? Price retraces back to the level, displacement out of the level. We then wait for price to come back again, after creating this fair value gap here. So we'd have a 1 minute fair value gap, as I said. 15-minute and the 1 minute time frame are aligned. So we wait for price to retrace into our 1 minute fair value gap, which is here. We then place a trade here. Stop loss would be above the level, because like I said, we are then covered for price to come back into the level and sweep liquidity. It has to break through the fair value gap in order to stop us out. We'd then place a take profit at the bottom of this level here because this is higher time frame liquidity. So here we'd have liquidity here. That's where we'd set a take profit, and hopefully price would take profit. That is fair value gaps. Let's quickly look at inverse fair value gaps. Inverse fair value gaps then, they're pretty much the same principle, but instead of respecting the level, we break through the level. Price is trending upwards. We take liquidity up here or something. So price takes liquidity and now it starts heading back down for a retracement, okay? But instead of respecting and giving displacement out of the level, we break through. So now we're trending downwards. So once we break through this level, it becomes an inverse fair value gap because price is then likely to retrace back to the bullish fair value gap. But instead of again going higher, we respect this level and we keep going down. Does that make sense? Let's go through again. So price takes liquidity at a level. We retrace back to the fair value gap, but instead of respecting it, we break through it. Okay. Now what we expect to see is price to retrace back to that fair value gap, which is now an inverse fair value gap. We can then place a trade in here. Again, we wait for a liquidity sweep. We wait for some kind of sign that market still wants to go lower. We then have a 1 minute bearish fair value gap because remember we've swapped now. So we're no longer bullish, we are bearish. We'd then wait for price to retrace back into that and then we'd enter a trade. Takeaway is it doesn't respect the level. So instead of reacting here, we smash through the level. We respect it when we are then going down. That's very key. So for the bearish, price is trading upwards. Instead of respecting it, we take the level, we smash through it, but then we respect it on the way back down. We look for a trade here. We have a 1 minute fair value gap, bullish fair value gap, remember. We then enter there and target the opposing liquidity. So that is both fair value gaps and inverse fair value gaps. Now I'm going to show you a quick trade idea of how we could use this in trade. Okay, so here I've marked out a very simple chart example. The red line and the red text is the 15-minute time frame. In the orange, we have a 15-minute fair value gap. Let me just mark that out for you. So here we have a 15-minute fair value gap. Now, whatever I draw in blue is going to be the 1 minute time frame because remember, as I keep saying, the 15-minute and the 1 minute are aligned time frames, okay? On the 15-minute then, we are trending upwards. On the way up, we create this 15-minute fair value gap. But not only that, we create liquidity here for price to take. Now say, for example, this is a bullish scenario. We're not talking reversals, this is a purely bullish scenario, okay? So we have liquidity resting at the top. We have our liquidity here created by the 15-minute time frame. We have our 15-minute fair value gap. Now what we're going to do is scale down to the 1 minute time frame. Now on the 1 minute time frame, we would like to see price retrace back down to our 15-minute fair value gap. So once we're in the fair value gap, we might have swept some liquidity on the 1 minute time frame somewhere down here, but we have to see that. We have to see a smaller time frame liquidity sweep as well. Okay, so say we swept liquidity, which was resting over here somewhere. What we then like to see is price has to tell us that it wants to continue higher. Okay, so here we have an area of liquidity on the 1 minute. We must see price close above this level. That is what we call a change in the state of delivery or a break of structure, a market structure shift, whatever you want to call it. It's all the same thing. So now if we zoom in, we have our 1 minute change in the state of delivery. What we'd then like to see, again, as I said, we'd like to see a 1 minute time frame fair value gap. Here we have our 1 minute fair value gap. What we'd like to see is price retrace back to our 1 minute fair value gap, which is also aligned with our 15-minute fair value gap. This is where we can enter a trade. Okay, so we enter a trade here. We put our stop loss below the 15-minute fair value gap or below the 1 minute liquidity area, which is here. We can then target the opposing level of liquidity, which is this high, which was created earlier. Then what we like to see is price might continue down. Price might sweep this level, but it's fine because we never put our stop loss just on the level. Always put it under it to give us some breathing room. Okay, so price will then come up, it'll continue rising and sweep our liquidity. So that is an extremely simple guide on how to use fair value gaps, how to trade fair value gaps, what exactly fair value gaps are, and why they're so important in your trade. I hope this video has been helpful. If you found some tips or you just learned a little bit about fair value gaps or you liked the video, then drop me a comment, drop me a like, drop me a subscribe and all that fun stuff. And I'll see you in the next video. Peace.